You might think buying a $500,000 house means you're doing well financially. After all, the lender approved the mortgage. The payment technically fits your income, and on paper, everything seems manageable. But there's a quiet difference between a house you can qualify for and a house you can comfortably afford. And that difference can shape the next 20 years of your financial life. Because mortgage approval answers one simple question: can you technically make the payment? But real affordability asks a different question: what will this payment do to the rest of your financial life? A $500,000 home can look reasonable during the buying process. The lender runs the numbers, your income fits the ratios, the mortgage gets approved. But over time, many homeowners begin to notice something subtle. Their finances stop expanding. Savings slow down. Investment contributions shrink. Unexpected expenses begin to feel stressful. Gradually, the house that once represented stability starts limiting financial flexibility. So this conversation isn't about avoiding homeownership. It's about approaching the decision differently. Instead of asking, what is the most expensive house you can qualify for, the more useful question becomes something else. What housing cost allows the rest of your financial life to keep growing? Because the structure of that decision often determines whether your finances expand steadily or remain permanently tight. Mortgage approval is not a financial strategy. Mortgage lenders evaluate affordability using standardized ratios. Two of the most common are the front-end ratio and the debt-to-income ratio. In many cases, lenders allow housing expenses to reach roughly 28% of gross income. Total debt obligations may reach somewhere between 36 and 43%, depending on the loan program. These formulas help lenders estimate credit risk, but they do not necessarily reflect how a household experiences cash flow in everyday life. The key reason is simple: gross income is not the money you actually spend. A household earning $120,000 per year may lose large portions of that income before it ever reaches their bank account. Federal taxes reduce it. State taxes may reduce it further. Payroll deductions take another portion. Health insurance and retirement contributions reduce it again. Suddenly, the take-home income looks very different from the salary that appears on a loan application. A mortgage payment that appears comfortable on paper can feel very tight once real-life cash flow is considered. This is why mortgage approval should never be treated as a target. It should be treated as a ceiling. Just because a lender says you can afford a certain house does not mean that decision supports the rest of your financial life. The hidden cost layer of homeownership. When people evaluate a home purchase, the focus usually stays on the mortgage payment, but the payment is only the most visible part of the financial picture. A $500,000 home also brings several additional layers of cost. Property taxes must be paid every year. Homeowners insurance protects the property but adds another expense. Utilities tend to rise as the size of the home increases. Furnishing a larger space often requires additional spending. And then there's maintenance. One widely used estimate in real estate is known as the 1% rule. It suggests homeowners spend about 1% of a property's value each year maintaining it. For a $500,000 house, that translates to roughly $5,000 per year. But maintenance rarely appears as a predictable monthly bill. Instead, it arrives unpredictably. A water heater fails. The roof begins leaking. An HVAC system stops working during the summer. A plumbing issue appears without warning. Each individual expense may be manageable, but when housing costs are already stretching the budget, these irregular costs can quickly create financial pressure. Housing can quietly crowd out investing. One of the most important financial consequences of expensive housing is opportunity cost. Every dollar committed to housing is a dollar that cannot be invested elsewhere. This trade-off is rarely obvious in the moment, but over time it becomes powerful. Imagine two households with similar incomes. Both families earn the same salaries and begin their financial lives at roughly the same point. One household purchases a $500,000 house. The other household purchases a $350,000 house. Because the second home is less expensive, the monthly housing costs are lower. That difference might amount to roughly $800 per month. Instead of absorbing that difference into lifestyle spending, the second household invests it. Month after month, that $800 goes into retirement accounts or index funds. If those investments earn an average return of 7% annually, the long-term impact becomes significant. After 20 years, the monthly investments grow to roughly $420,000. That difference did not come from extraordinary investment skill. It did not require market timing or risky strategies. It came from a single structural decision: housing cost. Housing costs and financial stress. Research has examined the relationship between housing costs and financial stability. The Harvard Joint Center for Housing Studies classifies households spending more than 30% of their income on housing as cost-burdened.
In the United States, tens of millions of households fall into this category. These households are statistically more likely to struggle with emergency expenses. They often have smaller financial buffers and less flexibility when unexpected costs appear. The reason is straightforward. Housing payments are fixed obligations. They cannot easily be reduced when financial conditions change. When a large portion of income is committed to housing, every other financial decision becomes constrained. Savings slow down. Emergency funds grow more slowly. Investment contributions become inconsistent. Housing is therefore not only a real estate decision, it is fundamentally a cash flow decision, and cash flow determines financial resilience. The house-rich, cash-poor trap. There's a phrase frequently used in personal finance: house-rich, cash-poor. It describes a situation where a household owns a valuable property but has very little liquidity. On paper, their net worth appears strong, but day-to-day financial flexibility becomes limited. Imagine a household where most income flows toward mortgage payments, property taxes, insurance, and maintenance. The family may technically be building home equity, but their ability to build retirement savings may be minimal. Their emergency fund may remain small. Unexpected expenses may force them to rely on credit cards or loans. From a balance sheet perspective, the household may appear wealthy. From a cash flow perspective, they may feel constantly constrained. Liquidity matters. Financial flexibility matters. And those qualities are often easier to maintain when housing costs remain moderate. Real estate appreciation is often overestimated. Another reason many people stretch for expensive homes is the belief that housing appreciation will justify the decision. Homes do tend to increase in value over long periods, but historical data suggests that growth is usually modest. A long-term analysis from the Federal Reserve Bank of San Francisco found that U.S. housing prices have historically increased roughly 1% above inflation each year over very long periods. That represents steady growth, but it is very different from the historical performance of diversified stock portfolios. Over long time horizons, broad equity markets have historically produced returns closer to 7% after inflation. This does not mean housing is a poor financial decision. Homeownership provides stability and lifestyle benefits that financial assets cannot provide. But it highlights an important distinction. A home is primarily a place to live. It is not usually the primary engine of wealth creation. A different strategy for housing. Instead of asking, what is the most expensive house you can afford, a more useful question might be this: what housing cost allows your financial life to remain flexible? Some households approach this decision using a simple guideline: housing costs below 25% of take-home income. Others simply focus on maintaining enough financial space for three priorities: consistent retirement contributions, a well-funded emergency reserve, and steady investment growth. When housing costs remain manageable, those priorities become easier to maintain.
The result may be a smaller home, but it often produces something more valuable: financial breathing room. With that flexibility, households can absorb unexpected expenses and continue building long-term wealth. The wealth-building difference over time. Small structural decisions often produce the largest financial differences over long periods. Behavioral research from Vanguard, examining millions of retirement accounts, found that consistent contributions were the strongest predictor of wealth accumulation, not market timing, not speculative investments, simply steady saving and investing over many years. That consistency becomes much easier when housing costs remain moderate. When income increases, the additional cash flow can move toward investments rather than higher mortgage payments. Over time, those contributions accumulate, those investments compound, and the financial trajectory of the household gradually shifts upward. The smarter housing question. Buying a home is one of the most important financial decisions many people will make, and there is nothing inherently wrong with purchasing a $500,000 house. The risk appears when the decision begins with the wrong question, when the goal becomes stretching to afford the largest mortgage possible. Mortgage qualification measures risk for the lender. It does not measure comfort for the homeowner. A more useful approach is simpler. Choose housing that leaves room for the rest of your financial life, room for savings, room for investments, room for unexpected expenses, room for financial progress. Because long-term wealth rarely comes from owning the biggest house you can afford. It tends to come from maintaining financial flexibility year after year. And sometimes the smartest financial move is not stretching for the bigger house. It's choosing the one that allows everything else in your financial life to keep growing. If this video helped you think differently about housing decisions,